Most investors are walking around right now completely asleep to what's actually happening in the oil markets. They're watching the stock market, they're checking their crypto portfolios, they're refreshing their news feeds every 5 minutes, but they're missing the single most dangerous macro setup that could unravel everything else. Here's the uncomfortable truth. We are closer to an oil shock than we have been since 2008. And when oil moves, everything moves. Your savings, your job, your investments, the value of your money itself, everything. But here's what most people miss. They think oil shocks are random. They think they come out of nowhere. They think they're acts of God or pure geopolitical accidents. But they're not. Oil shocks are the symptom. The real disease is something much deeper. And if you understand the disease, you can see the shock coming. By the end of this video, you'll understand the mechanism that's about to trigger the next oil crisis. You'll know why this time is structurally different from the past, and you'll know exactly what to watch to position yourself before everyone else wakes up. Let's start with what you're seeing right now. Oil prices seem stable. Crude is trading in that range around $75 to $85 a barrel. It's not screaming from the headlines. It's not making CNBC reporters panic. So most people think energy is fine. The energy crisis is over. We moved on. But that's only the surface explanation. Because underneath that calm surface, something is shifting. Something is breaking. And the people who understand energy markets, the people who actually work in supply chains, the people who run refineries and shipping operations, they're not calm at all. Here's the real mechanism. Step 1. Global oil production is becoming increasingly fragile. The world uses about 102 million barrels of oil per day right now. That's the baseline. That's what we need just to keep everything running. 102 million barrels, every single day. Without it, economies don't function. Now, where does this oil come from? The Middle East, Russia, the United States, West Africa, the North Sea, Brazil, a handful of megafields around the world that are aging and declining. And right now, we are living in a world where new major oil discoveries have basically stopped. The era of finding massive new oil fields is over. And this is where everything changes. Because the old fields are depleting, they're running dry. The giant fields that came online decades ago are in terminal decline. Production naturally falls by about 3 to 5% every year just from the physics of how oil reserves work. You pump less and less as the field gets older. So where does the replacement supply come from? It comes from expensive, difficult projects. Deep water drilling, Arctic exploration, shale oil in the United States. Projects that require massive capital investments, stable geopolitical conditions, and reasonable oil prices to be economically viable. Step 2. Geopolitical tension is making supply increasingly fragile. Right now, we have a simmering conflict in the Middle East. We have tensions in the Red Sea that are disrupting shipping lanes. We have sanctions on Russia that are constraining major production. We have tensions between the US and China over Taiwan and the South China Sea. Any one of these could turn hot tomorrow. And if any of these turn hot, oil facilities get hit, shipping lanes get blocked, refineries shut down, production gets cut off. And suddenly, the supply side of the equation is in shock. Step 3. The demand side is more rigid than it's ever been. Here's what people don't understand about oil. You can't just stop using it. You can't flip a switch. The global economy is built on oil. Your food is transported by oil-based fuels. Your electricity is generated partly with oil. The plastics in your phone are made from oil. The materials that build electric cars are mined with diesel-powered equipment. Oil is completely embedded in civilization. So when supply tightens, demand doesn't fall proportionally. Instead, prices spike. They spike hard. Because people still need the oil, they just have to pay more for it. Step 4. The financial system is more leveraged than it was in 2008. This is the part that terrifies people who really understand macro. Global debt is at an all-time high. Government debt, corporate debt, household debt. The entire system is balanced on a razor's edge of cheap energy and low interest rates. An oil shock doesn't just raise the price you pay at the pump, it raises inflation. Central banks have to respond by keeping interest rates higher for longer. Higher rates mean that all of this debt becomes more expensive to service. Companies that were profitable at 3% interest rates become unprofitable at 6% rates. They lay people off. Unemployment rises. Consumer spending falls. And the cycle compounds. But that's only the surface level. Here's what most people miss. When oil spikes, it doesn't just affect energy stocks. It affects everything. It affects the airlines, which have to pay more for jet fuel. It affects transportation companies, which have to pay more for diesel. It affects farmers, who have to pay more for fertilizer made from petroleum. It affects food prices. It affects shipping costs. It affects every consumer price in the system. And this is where the real shock hits the economy. Because inflation comes screaming back. Not the sticky wage inflation that the Fed created by overspending, but the old-fashioned commodity inflation that destroys purchasing power. Your paycheck buys less. Your savings become worth less. The government can't just print its way out of it like they did in 2021 and 2022, because that just makes inflation worse. So the Fed has to choose. Let inflation run hot and destroy the currency, or keep rates at levels that break the financial system. History shows this pattern again and again. In 1973, OPEC embargoed oil to the United States over the Yom Kippur War. Oil spiked from $3 a barrel to $12 a barrel. Oil lines formed in America. Unemployment spiked. Inflation spiked. The economy went into a brutal recession that lasted until 1975. In 1979, the Iranian Revolution cut off Iranian oil exports. Oil spiked again. Inflation hit double digits. Paul Volcker had to raise interest rates to 20% to kill the inflation. That triggered a massive recession in the early 1980s. Unemployment hit 9.5%. In 2008, oil spiked to $147 a barrel. The global financial system melted down. You know what happened after that. In 2022, after Russia invaded Ukraine, oil spiked above $100 a barrel. Inflation reignited. The Fed had to raise rates aggressively. We got the fastest tightening cycle in decades. Every single time. Oil shock equals economic shock. And here's the pattern. Every time we think we're done with oil shocks, we're wrong. Because the fundamental problem never goes away. We still need more oil than we're producing. We're still dependent on unstable regions to supply it. We're still one geopolitical event away from a major supply disruption. But here's what's different this time. In the 1970s, oil shocks were a surprise because we didn't understand them yet. We didn't have strategic petroleum reserves. We didn't have flexibility. Now we understand the problem, but our system is more fragile, not less. Here's why. The dollar system is built on petrodollars. The entire global financial structure depends on oil being priced and traded in dollars. Every central bank holds dollars. Every oil trade is settled in dollars. When oil prices spike and stay spiked, it creates enormous pressures on the dollar. And right now, the dollar is already under stress. Central banks around the world are diversifying away from dollars. China and Russia and other nations are building alternative payment systems. The dollar's role as the world reserve currency is being questioned for the first time in 70 years. An oil shock would accelerate this trend dramatically. Higher oil prices would make dollar-denominated debt even more expensive for countries that have to import oil. They'd be forced to sell dollars and buy other currencies just to afford energy. That would weaken the dollar further. That would push more countries away from dollar-based systems, and the process would feed on itself. At the same time, an oil shock would spike inflation again, which would force the Fed to keep rates higher. Higher rates would make the government's debt burden unsustainable. We're already spending more than $2 trillion a year on interest payments. Higher rates would push that higher. At some point, the math breaks. And this is where everything changes. Because you can't solve a debt crisis by printing money if an oil shock is reigniting inflation. You can't solve an inflation crisis by printing money. So the Fed would be trapped. They'd have to choose between allowing deflation in debt and assets or allowing the currency to debase further. Either way, gold and silver become the hedge that actually works. Here's what smart money is quietly doing right now. Central banks are buying gold at the fastest rate in decades. The People's Bank of China has been buying gold consistently. Russia can't use its dollar reserves, so it's holding gold. Middle Eastern sovereign wealth funds are diversifying into precious metals. These aren't conspiracy theories. These are official announcements from government institutions. They're positioning for a world where the dollar and the debt-based system come under severe stress. Now, when does the oil shock actually hit? Here's the mechanism. It could come from a hot war in the Middle East. It could come from a blockade of the Taiwan Strait that disrupts shipping. It could come from a political collapse in a major producing nation. It could come from an unexpected hurricane season that takes refineries offline. It could come from sabotage or terrorism targeting infrastructure. The trigger doesn't matter. What matters is that the system is set up for a shock. When it comes, here's what happens next. Phase 1. Oil spikes 30 to 50% in a matter of weeks. That happens fast. Markets get shocked. Volatility spikes across all assets. Phase 2. Inflation data starts rolling in hot. Food prices rise, transportation costs rise, input costs for manufacturers rise, inflation expectations start rising. Phase 3. The Fed is forced to either hold rates steady and watch inflation accelerate, or raise rates further and watch debt markets seize up. They pick a painful choice. Phase 4. Equity markets start to struggle because profit margins compress under inflation and stocks become less attractive relative to bonds. Some sectors get hit harder than others: airlines, logistics, transportation, retail. Phase 5. Credit spreads widen. Companies with poor balance sheets start to struggle. Bonds that looked safe start to look risky. The investment-grade bond market starts to show stress. This is the phase that most people miss. Credit stress is the amplifier. It's what turns an oil shock into a financial crisis. And this is where precious metals shine. Gold and silver don't have counterparty risk. They're not someone's liability. They're real money. They have a 5,000-year track record of being valuable when currencies come under stress. So what should you actually be watching? Signal number 1. Watch crude oil if any geopolitical event impacts Middle East stability or shipping lanes. If you see oil spike above $100 and hold that level, that's your warning sign. That's when the mechanism starts. Signal number 2. Watch the spread between long-term and short-term oil prices. This is called the crude oil curve. If it inverts or flattens, it suggests the market expects supply stress. Watch for that. Signal number 3. Watch the dollar index. If we get an oil shock, watch whether the dollar weakens or strengthens. If the dollar weakens when oil spikes, that's a sign that the reserve currency is coming under pressure. That accelerates the shift to alternative assets. Signal number 4. Watch credit spreads. Watch the spread between junk bonds and treasuries. When that widens, it means the market is getting nervous about credit risk. That's when the Fed is really trapped. They can't raise rates without blowing up the bond market, but they can't hold rates without inflation running hot. When you see credit spreads widen significantly while oil is elevated, that's your signal that the system is moving into crisis mode. Here's what you need to understand right now. We are in a very unusual moment in history. We have all-time high debt. We have geopolitical risk at levels not seen since the Cold War. We have an energy system that's becoming more fragile, not less. We have a currency system that's being questioned. And we have interest rates at levels where that debt becomes very expensive. All of these things are true at the same time. Add an oil shock to this mix, and the system doesn't just stumble, it has a crisis. But here's the thing. Most investors are walking around completely oblivious. They're focused on earnings reports and Fed meetings and whether unemployment numbers will be strong or weak. They're missing the biggest picture. The biggest picture is this. The era of cheap, abundant energy is ending. The era of cheap, abundant money is ending. The era of dollar dominance is being challenged. And the era of cheap debt is definitely over. What comes next is an era where physical assets matter again, where hard money matters, where you don't want to be a creditor, where you don't want to be dependent on a system that's becoming fragile. This is not a crash course in doomsaying. It's not about being afraid. It's about being realistic. It's about understanding the mechanism. It's about positioning yourself logically. Gold and silver aren't speculation. They're insurance. They're the hedge against a system that's under stress. And every smart investor carries insurance. The oil shock might not come tomorrow. It might not come next month. But the probability is rising. The pieces are on the board. The conditions are in place. And when it does happen, it will happen fast. The investors who understood this mechanism beforehand will be ahead. The investors who didn't understand it will be scrambling to figure out what just happened. You now know the mechanism. You now know what to watch. You now know why precious metals matter in this scenario. What you do with this information is up to you. If you want more deep macro analysis like this, if you want to understand the real mechanisms driving markets instead of just reacting to headlines, subscribe to this channel and stay close. We'll keep breaking down the big picture for you. The future is closer than you think.